Okay, welcome everyone to the latest in our series of catchily named Life After Lockdown webinars. Today's, as you can hopefully see on your screens, is an accounting update. So if you've logged on to the wrong one, now's your chance to leg it. I'm Dave Redhead, one of the audit partners here at UNW, and joining me today are Leanne Smith and Martin Oliver, both audit managers at UNW, who will cover off the trickier stuff in today's presentation, obviously. Before we get going, just a couple of housekeeping points. You should all be able to see a Q&A icon if you hover your mouse over the screen at the bottom, I think. If any questions do occur as we're going through, then feel free to drop it through to us via the Q&A button, and we'll endeavour to pick up as many of those as we can at the end. You should also have a chat icon. If you do have any technical issues, we've got a crack team on hand, so hit the button and we'll do what we can to sort you out. So moving on to today's webinar, the plan is to spend around 50 minutes taking you through the material, providing some examples as we go. Then there'll be some time at the end to pick up on those questions. The plan is to keep things to an hour tops, so you can all log off around 5, although you will be directed to a feedback page and a link, and if you could just take a couple of minutes to fill that in at the end, we'd be very grateful, just to let us know what works well, what we can improve, etc. Allows us to offer an events program with topics that you'd like to see. Right, okay, so moving on to what we're going to be covering today. We'll be discussing some of the issues thrown up by COVID and the accounting implications, in particular, repercussions for the going concern basis of preparation and what you can be doing to get ahead of this. Whether COVID is an adjusting or non-adjusting event insofar as it's had an impact on numbers in your annual accounts. Largely depending upon what your year end is. And in this regard, considering potential impairment of a range of assets. Then we'll also touch on a few points regarding financial covenants, which are a bit of a hot topic at the minute. We'll be providing some guidance for when you come to working out how to account for either commercial arrangements or any government support schemes you may have taken advantage of over the last few months and still are doing so, such as lease waivers, amendments, business rates holidays, job retention scheme or furlough funding, civils loans, both short and long term, some slight differences there. Just on these two areas, there's actually nothing new when it comes to the accounting requirements. What's new or different are the circumstances we're in. Fortunately, global pandemics are fairly infrequent. It's the range and extent of interventions which have been available or which you've managed to negotiate commercially to help businesses through a very challenging period and one that's ongoing, that's different, and it's applying existing accounting rules to those different circumstances and different ranges of transactions. After that, we'll also touch on some new narrative reporting requirements for larger corporates, and finally just a quick reminder of some key changes coming out of the FRS 102 triennial review. Which happened in 2017, but only kicked in for December 19 year ends. And we're pleased to say it's mostly good news with some of the nonsense requirements taken out. So we'll be ending things on a high. Okay, so on to accounting implications of COVID-19 and specifically going concern. I'll kick things off here with this fairly emotive subject of going concern in light of COVID. Just some brief background first. Way back in March, shortly before the UK lockdown was imposed, there was just so much uncertainty around that regulators were actually encouraging companies to delay reporting, if at all possible. For those that couldn't or wouldn't, the likelihood was that there would be a far greater number of material uncertainties over future viability flagged by directors and their auditors when accounts were published. In practice, the majority did delay publishing or filing or approving their accounts, and these have been coming through more recently now that we're a few months down the line, and indeed Companies House, for example, have helped the cause here by freely agreeing to filing extensions of 3 months. There's a bit more on that later from Martin. This wasn't just to allow management and boards to focus on their businesses, it was an acknowledgement that it was just so difficult for anyone to provide forward-looking information with any degree of certainty, or to form a reliable view on a business's going concern status, as company directors are required to do when signing the annual accounts. Now, a few months down the line, we have experience of coping with the lockdown, and obviously it's impacted different businesses in different ways. Some uncertainties have unravelled, however, there's still a lot of unknowns, be that around employee availability or operating capacity in light of distancing requirements, supply chain and the continued availability of key supplies, customers and counterparty risk attaching to sales and collecting payments, as well as sales opportunities being pushed out. It's improbable that activity levels will just bounce back to pre-COVID levels. Even just this week, there's concerns over spikes in Europe, and more areas of the UK have become subject to localised lockdowns. So we're obviously still not out of the woods. And all of these circumstances are clearly relevant to forming views on the going concern status of a business, which unsurprisingly has required greater focus from companies and their auditors, and it continues to do so. So what should the thought process be? Well, firstly, the going concern basis of preparation, and I'm talking in general terms here, but I'll use a private company as an example. The going concern basis of preparation is presumed for all companies, unless a decision has been taken to cease trade or the directors are faced with no alternative but to cease. So for everyone else, the assessment is somewhere between there being no uncertainty through to there being material uncertainties that the business will be able to pay its liabilities as they fall due. And in the UK, that needs to be considered for a period of at least 12 months after the accounts are to be approved. So for example, a business with a July 2020 year end signing off their accounts in October should really be forecasting through to at least October 21. So what should you have and what's important when it comes to assessing going concern? Well, for pretty much everyone, previous budgets will now be out of the window, and even though many will have been running on short-term, maybe 13-week forecasts, the longer-term forecasts should be updated for what you now know to reflect both actual results to date and realistic, rather than perhaps previous assumptions for the next 12 months plus, with any support available to inform sales forecasts, margins, overheads, and the timing of cash flows both in and out of the business. And clearly these assumptions may well or even are likely to have changed. Also consider alternative scenarios when it comes to the key assumptions. So if plan A doesn't happen, sensitivity analysis allows you to show how the alternatives would impact financial headroom, and if you're able to do that and maintain a reasonable level of headroom, then the robustness of those forecasts is pretty compelling in forming the view on going concern. And whilst profits are great, and there's usually a correlation, it's cash headroom that matters. And fundamentally, this is about demonstrating how a business can continue to pay its liabilities as they become due in the normal course of trading. Finance facilities are clearly relevant here too. So availability under overdrafts, ID lines, loan facilities, etc., all contribute to the headroom available and the assessment on going concern. But with this, you do also need to have regard for any covenants written into your facility agreements, and there's a bit more on this later. And of course, how long those facilities are available to you for. A facility ending in a couple of months' time, clearly you can only place so much reliance on that. Whereas if they can be negotiated and rolled over and made available throughout the look-forward period, then that's a lot more compelling and useful. And finally, just some comments on disclosure in your accounts regarding going concern. The standing guidance is that unless there's no uncertainty regarding the going concern basis of preparation and status, as a minimum, businesses should provide a rationale as to why the going concern basis remains valid, and flagging any material uncertainties that do exist. As fewer and fewer businesses currently fall into the no uncertainty camp at present, you should expect to be making reference in your accounts, and that would be strategic reports, which are required for all but small companies, and small companies can opt to include a strategic report. And these call for information to be provided in relation to risks and uncertainties, post-balance sheet events, and future developments within the business. Now, clearly, the impact of COVID and the continuing impact is relevant to all of those areas, which is why robust comment around what you've done and what you're doing and what you've done to stress test the forecast is relevant there. As well as that, there's the basis of preparation in the accounts, and this is where the director's rationale and any material uncertainties, if there are any, should be disclosed in a set of accounts. And finally, where there are considered to be material uncertainties, this would be mirrored in the audit report where the company's accounts are also audited. Most commonly, this is through an emphasis of matter, which simply draws attention to the director's assessment, which is already disclosed in the accounts. And to be clear here, an emphasis of matter is not a qualification. Okay, so moving on to the next slide, impairment reviews and whether something is adjusting or non-adjusting. If you're carrying assets whose value have been adversely impacted through COVID, one question is, when should any write-down be reflected? And the answer depends on your year end and whether COVID is an adjusting or non-adjusting event. In other words, was it a condition which existed at the year end? Simplistically, so for a December 19 year end, most UK companies would likely regard COVID as not having had a significant impact at that point in time. Whereas for March 2020 year end or beyond, a global pandemic had been called and the UK was in lockdown. So it had happened, and any adverse material impacts as a result of COVID should therefore be reflected in March 20 year ends and beyond. The impact could be across a range of asset classes, such as those listed on the slide here. Potential impairment of fixed assets, investment property should be considered, and where their recoverable value has fallen below their book or carrying value, an impairment loss should be recognised. Similarly, for other assets such as debtors or stock, if a customer is unable to pay you because the impact COVID has had on their business, then a provision will likely be required in any accounts from March 20 onwards. And similarly for, let's say, a hotel or a shop, which is holding perishable stocks like food, the write-off would be reflected in any accounts from March 20 onwards. Conversely, if these businesses had December 19 year ends and those circumstances were clearly post year end, even if you were holding debtors or stocks at December 19, then the assessment may well be different. Okay, and just finally for this bit, on to covenants, financial covenants, bank covenants. I touched on this earlier when we were talking about forecasts, and again, there's nothing new here. What's different is that businesses haven't, on the whole, haven't been able to operate as normal for the last few months, obviously. And as for the challenge with forecasting, even the immediate future is more uncertain than was previously the case. In that context, covenant requirements and facility agreements, both financial and non-financial, and in the case of financial covenants, were likely set originally based on historic forecasts that were prepared at the time of the financing being arranged. Clearly, they've now been overtaken by more recent events and are, in a lot of cases, in doubt of being achieved. As covenants, as part of a lending agreement, are contractual terms, which may enable the lender to withdraw funding, i.e. demand repayment. The implications here are twofold. Firstly, breaches during the financial year mean that the accounting should follow the contractual terms, and any long-term debt under that lending agreement should become classed as short-term because it's become repayable on demand. Clearly, this weakens the balance sheet position. Any continuing breaches from the year or future anticipated breaches may also have another implication in that they could result in concluding a material uncertainty in your going concern assessment. So if you're not in a position to repay the debt if it's called in, that could present significant issues. Unsurprisingly, this isn't an unusual situation at present, and it applies equally to those companies who weren't showing any signs of significant financial stress pre-COVID. And as I said, that's because things like covenants were set based upon a business's own forecasts rather than comparing to other businesses. So what we are also seeing is that lenders are willing and able to be supportive in this environment. So if this is an issue for you, or you think it's going to be an issue for you and you haven't already, I would urge you to speak with your lender. The best case scenario here is that you can agree either amendments to your covenant requirements and or obtain waivers in respect of specific covenant breaches. under which the lender effectively forgoes their right to call in the debt. If you're in breach and heading toward a year end, remember it's the conditions that exist at the balance sheet date. So the discussion there is really around trying to agree something in advance of the breach happening. So a preemptive waiver or a preemptive amendment to the covenant requirements. As the accounting, as I said earlier, will follow the contractual terms that exist at the balance sheet date. Okay, hope that's been useful. We'll switch tack now, and Leanne will take us through the accounting treatment of various schemes and other areas that have cropped up during the course of COVID. Over to you, Leanne.
Thanks, Dave. My name is Leanne Smith. I'm an audit manager here at UNW, and over the next few slides, I'm going to take you through the accounting implications of some of the government schemes that have been put in place in response to the coronavirus pandemic. So we're going to start off by looking at rent and rates holidays, and also covering the furlough scheme and the business interruption loan scheme as well. So as a result of the COVID-19 pandemic, many companies have received rent holidays from their landlords. Any rent holiday should still be accounted for as an expense in the period to which it relates, but the unpaid rent needs to be recognised as a creditor balance until this is paid off at a later date. So key thing with this is a rent holiday is not recognised the same as a lease incentive or a rent-free period, unless the landlord also renews, modifies or extends the lease, as some examples. And then also on there is just an onerous lease. So an onerous lease is where the obligation under the lease is greater than any benefit derived from the lease. So any shortfall should be provided for in full as soon as this is known about. So as an example with this, in the hospitality sector, if a pub or a restaurant, for example, had to carry on paying rent for a period of time when the business isn't allowed to be open due to government guidelines, then this would indicate that the amount owed under the lease is greater than any benefits derived from the lease. So this is the point that a provision should be recognised. This is also the case if, for example, an office or a branch is closed, but there's still time left to run on the lease. So just moving on to business rates holidays. So eligible nurseries and businesses in the retail, hospitality and leisure sectors won't have to pay business rates for the 2020-21 tax year. So a business rate holiday should be recognised across the period in which it relates. And this represents a reduction in the rates expense rather than, for example, a grant from the government. So, for example, if the financial year of the business is aligned to the tax year, the company would have a nil rate expense for the year. But in most cases and practically, the financial year is going to be different to the tax year. So that's when we'd need to consider time apportionment with regards to this. So just as an example there, like we've got on the slide, so for an eligible business with a 31st of December year end, who typically have a 20,000 annual rates bill, they would need to calculate the proportion of that annual rates expense, which relates to the 1st of January to the 5th of April 2020, and that's what you would recognise in FY20. So in this specific example, that's just over 5,000, and then a similar calculation would need to be done for FY21. So then just moving on to one of the bigger areas in terms of the furlough or the job retention scheme. So just as a brief overview, this results in cash payments from the government to compensate employers for part of the wages, associated NI, and also the employer pension contributions of employees who've been placed on furlough. So in substance, this is a government grant. And again, like Dave said earlier, nothing new with regards to this. So this should be accounted for in line with section 24 of FRS 102. So under FRS 102, companies can recognise grants on either the performance or the accruals-based model. It's a key thing to note here that that's an accounting policy choice, so that's something that will need to be disclosed within the notes to the accounts. But practically, the accounting treatment of the grant is the same under either model. So the grant income should be shown as other income within the profit and loss account as the company becomes entitled to it, which in both cases is over the furlough period of each relevant employee. Any salary expense should be recognised as it usually would be, and the grant income should not be net off against any wages and salaries costs. So you would still show your normal wages and salaries costs in the P&L, and you'd have your grant income as well, showing where you've received your furlough income. And then with regards to the balance sheet side of this transaction, you're either going to have an accrued or a deferred income balance, just depending on when the cash is received from HMRC. So as an example there, if a company with a junior end submits a furlough claim covering June and July payroll costs, but receives the payment in July, then the June element of the income should be recognised as other income with an associated debtor in the June accounts until that money is received in July. The July portion of that, in terms of the income, wouldn't be recognised until July, so in this example, in the next financial year. So then just moving on to the CBILS, or the Business Interruption Loan Scheme. So this is an arrangement which is made up of a bank loan, a government-backed guarantee, and then also a business interruption payment, where the government covers any fees and interest payments for the first 12 months. Essentially, these are loans into the business, so should be recorded as a liability with any interest paid recorded as an expense in the P&L. The loan amount should be split and classified as either a current or a long-term liability. We'll also come back to the interest element just in the next couple of slides. So the key thing to consider with any of this, before we just look at some examples, is that it's dependent on the terms of the loan agreement in place. So any treatment will change just depending on the individual loan terms for each company. The next thing to look at is then probably the unusual elements of the business interruption element of the loan, and whether this leads to the loan being classed as a non-market rate loan. So there's potentially different treatments for the business interruption payment, just depending on how this is covered in the loan agreement. But in most cases, and what we're tending to see practically, that this is a direct payment from the government to the bank. So that's the situation that I'm just going to focus on for the next couple of slides. So if a company takes out a long-term loan with the government covering the first 12 months of interest, then the company won't have to pay the full interest charge on the loan. So it becomes a non-market rate of interest from the company's perspective. Under FRS 102, if a long-term loan is given at a non-market rate of interest, then the present value of the loan should be calculated at the initial recognition stage, and then payments are discounted back using a typical market rate of interest. So in practice, we've seen a couple of examples how this might be working. So the first one is if a company takes out a CBILS loan and it's in the loan agreement to be repaid within 12 months of the next year end date. In this example, this would be classified as a short-term loan, so you wouldn't need to consider discounting, because in this case, it only applies to long-term loan agreements. So in this case, you'd have a creditor for the loan amount until this is repaid, and would treat any interest charge, if there were any, as normal. The other two situations there are where the company takes out a long-term loan with, as we've already discussed, the first year interest covered by the government. So they might intend to pay it off over 12 months or 2 years, or actually over the full loan agreement term. But in both of these cases, as the loan is long-term per the agreement, this is where the impact of discounting needs to be considered. So just as an example there with some numbers, just to demonstrate how this would work. So if a company takes out a £100,000 CBILS loan over 5 years at 5% interest, with the government covering the first year's interest, then based on what we've previously discussed, this would be a non-market rate loan. The table on the slide there shows the numbers to be recognised for each year of the loan agreement. So in this case, the loan needs to be discounted back when it's received to reflect the fact that the first year's interest charge isn't being paid by the company. So on day one of the loan, you'd recognise cash of 100,000, a liability of 95, and the remaining difference would be recognised as finance income. So the 95,000 is calculated by discounting the total £100,000 loan at 5% for 1 year, like the calculation is shown just above the table there, as the government is only covering the first year of interest. So at the end of year one of the loan term, so sorry, that was covering the initial recognition there, and then at the end of year one of the loan term, you charge the £5,000 interest cost to the P&L as if it was a normal loan. And at that point, you would increase the liability to 100,000. So at the end of the first year of the loan agreement, you'll have a creditor of 100,000 and 5,000 showing as both grant income and finance cost. So you'll have nil net impact on your P&L. If we then assume equal repayments, this would be paid off, and also interest would be charged and recognised in line with the table shown, and the shown treatment for end of year 2 onwards would just repeat for year 3, year 4, etc. But again, with this, as I kind of said initially, it's all dependent on the terms of the loan agreement. So the treatment would need to be considered in line with any agreement in place, and your usual audit contact would be able to advise further on this if you had any questions with regards to the calculation. Sorry. There we go. So in the current environment, many businesses are likely to be reviewing their operations. So we thought we'd just cover a piece here on restructuring and employment taxes. So for example, companies might be looking to reduce staffing levels and mothballing certain activities, or maybe looking into selling some of the company's assets. So key thing to know is that a restructuring provision must be recognised only to the extent that there's a constructive obligation at the balance sheet date, alongside the general recognition criteria for provisions. So if contracts have been modified or terminated, this might have implications for the amount recognised as employment costs to the entity. And also, depending on the restructuring, there may be additional bonus payments, share-based payments, or pension liabilities, which need to be accrued for at the year-end date, which are to be settled in the future. In addition to this, there's just a few employment tax anomalies to consider when going down this route. So we've highlighted the ones there on the slide. And if you think any of these items may be relevant to your company, then we'd recommend discussing this with your normal audit contact, or potentially getting put in touch with Lee Muter, who's our employment taxes partner. He'll be able to provide further support and assistance with regards to any of these items on there. And then just lastly for me, before I hand over to Martin, I'm just going to run through some of the other areas or schemes that are currently in place. So we'll start off just looking at VAT deferral. So the VAT deferral applies to UK VAT registered businesses that have a VAT payment due between the 20th of March and 30th of June 2020. So this relates to VAT return periods ending 29th of February, 31st of March and 30th of April. Any payments on account due in the period, or any annual accounting advance payments due in the period as well. So key thing to note, this is simply a deferral of the VAT amount due, so it doesn't result in any reduction of the amount owed to HMRC. So the amount owed should continue to be recognised as a creditor in the accounts until it's paid. Again, important to note with this that after the 30th of June 2020, all VAT returns and future payments must be made on time from that date, and any deferred payments must be made in full or in instalments by the 31st of March 2021. And then just looking at, so we'll just look at time to pay arrangements in terms of corporation tax or PAYE amounts due to HMRC. So with these, the treatment of these is the same as we've just discussed with VAT. So these are deferrals of the amounts due and not reductions in the amount owed. It's likely for these arrangements that interest will still be accruing. So this needs to be accounted for in line with the agreement reached with HMRC. Again, with the position at the balance sheet date is the one that needs to be reflected in the year-end accounts. Then just a few things to highlight on holiday pay. So, and the holiday pay accrual specifically. So workers may be able to carry over untaken leave into the next 2 years if they can't take it because their work has been affected by coronavirus. So this might lead to an increased holiday pay accrual balance, just depending on each company's individual holiday policy. Also, if any unused paid annual leave rolls over into a period longer than 12 months, this might create a long-term employee benefit for all or a portion of the holiday pay accrual. Normally, as we've discussed previously with CBILS, long-term benefits would be discounted to their net present value, but I think it's unlikely in practice that discounting these benefits are going to be material. So the undiscounted amount is likely to be acceptable in the majority of cases, but again, it's just something to consider. And then last but not least, there's a number of other grants available, including the Small Business Grant Fund, the Retail Hospitality and Leisure Grant Fund, the Discretionary Fund, and then also the Bounce Back Loan Scheme. So for all of the funds, which are the top 3 ones there that I've just got starred in the slide, The treatment is the same as for the furlough income, so these have the grant funding approach. So the income is shown as other income when the grant becomes receivable, and then you'll have a corresponding debtor until the cash is received. So for these grants, they're likely to be receivable when the scheme eligibility criteria were first published, or when confirmation of entitlement was received from the local authority. The bounce back loan scheme, just slightly different, and this is a loan received, so should be recorded as a creditor in line with the CBILS treatment as above. The bounce back loan is likely to be a long-term liability, but this depends on the loan term and agreement, and then obviously the interest rate with regards to seeing whether that's non-market or not. So that's everything for me. I'm now going to hand over to Martin, who's going to chat you through filing extensions and also look at the triennial review.
I am. Thank you, Leanne, and afternoon, everyone. So as Dave kindly introduced, I'm Martin Oliver. I work alongside Dave and Leanne in the audit department here at UNW, and I'm going to take you through to the end of our main content with updates in areas which are a little less COVID related, at the risk of being less topical than the topics covered by Dave and Leanne there. However, there's one thing I would like to start off with, which kind of wraps up that COVID related material quite well, and that's in relation to the filing of statutory accounts, as Dave referred to, where I'm sure a lot of those watching have these deadlines looming. So that's just on the next slide there. I think we're still on the other key areas of time to pay. So yeah, particularly those December 2019 year ends that didn't file before the lockdown period, and maybe just others that have already looked into their options around extending their typical filing deadline. So on the left hand side there, we've set out the key details of that filing extension option that comes into play essentially at the start of the lockdown period. This is a joint initiative between the government and Companies House, intending to give everyone that additional 3 months to file. And the most recent update that we've had told us that this would remain in place until the 5th of April 2021. So in that respect, I think we're talking about any current filing deadlines coming up, any recent year ends up to June 2020, who would ordinarily have a March 21 filing deadline, would be captured by that filing extension. We've seen this on a number of occasions now internally and applied on behalf of some of our clients. And it's fair to say that this has been a fairly painless exercise, I think, through Companies House. It appears to be working very well, especially for those who've took advantage of it so far. The final 2 points there, just to be aware of more than anything. You can't do this if you've already extended your filing deadline, as well as shortened your accounting period. So you would be excluded there. And again, given the dates in point 1, this is a temporary measure. It's intended to help those who have a looming filing deadline and are up against it a little bit, but also those who are understandably focusing their attentions elsewhere within the operations of the business, as opposed to prioritising those year-end accounts. Over on the right-hand side, you've got a very similar situation that applies to those with a charity or charitable company status, whereby you do apply via the designated email address there. And again, you would usually provide some brief reasoning around citing COVID-19 as your reason, and we generally have very few issues in those extensions being granted. In this case, your accounts may still show as outstanding, we've found, with the Charity Commission, but as it says there, they're aiming to be very flexible and supportive by saying, get your accounts into us if you can, but if you can't, just let us know by the designated email address there. So I suppose that does bring to an end our COVID-related material that we have. There is a reminder again on the right-hand side there of an alternative approach to delaying accounts filing. This has always been in place, and that is the option around lengthening your accounting period. So a couple of kind of housekeeping things to note on that. This only applies to your current or prior period if we're looking at lengthening that accounting period. You can't already do this if your accounts are overdue, something to bear in mind. We can lengthen to a maximum of 18-month period, but we can only do that at once every 5 years. But we can also shorten that again, let's say to your usual year end if that's the preference. And it's important to note that you can shorten as many times as necessary to get that job done. So on to something now a little bit more left field. And this is around the updates to what should now be included as standard in those strategic reports of large corporates, as Dave pointed out at the start there. Therefore, a reminder on the left-hand side, first of all, of who would meet the definition of a large company. And those are the 3 criteria whereby we need to hit 2. And that is turnover of 36 million, gross assets of 18 million, employees of over 250, meet 2 out of the 3, you're classified as large. And then the fact that the majority of these requirements will come into play for periods commencing the 1st of January 2019. So the application period here would be the December year ends, the December 19 year ends, which may be coming up to their September filing deadline. Again, subject to that previous slide and whether we've been granted any of those extensions. And then subsequent year ends throughout 2020 where this will apply. So on the right hand side, I'll attempt to try and cover off 5 main features which are detailed. However, truth be told, there is a little bit of overlap in these requirements, particularly on points 2 and 3 there in relation to employee engagement and suppliers and customers in point 3, where these are also requirements of that point 1 there in a section 172 statement, which I'll come on to. With point 4, I'll provide a bit of an understanding of what is now required for disclosure in relation to new energy and carbon reporting, which on the surface looks to be the trickiest of the lot, you'll be glad to hear. And then finally, I will briefly touch on that corporate governance statement there, but as you can clearly see, this relates to a significantly different size of company altogether, and those with turnover of over 200 million, assets of 2 billion, or those who have employees over 2,000. So we'll start off with the section 172 statement, which I think is the meatiest part of this content. So with section 172 more generally, we're talking about the duty to promote the success of the company, and specifically the actions of the directors in doing this for the benefits of members and shareholders. So the focus here should be on strategy to drive the material for this statement. This is not just setting out what we believe the directors' responsibilities are, but how we've met those responsibilities. So section 172 states there that you should have regards to the points on the right, which we can whiz down, and they are the consequences of long-term decision making within the entity, having regard and interest of the employees, the business relationships there held with key suppliers, key customers, or any other key stakeholders that you consider relevant to your individual circumstances. The impact of your own operations on community and on the environment. Point E is all to do with maintaining a reputation of high standards in the way we conduct our business. And finally, that need to act fairly between members of the company. So as you can see, fairly broad categories generally for potential points to be included in that statement, which then slots into the strategic report. But potentially more important than ever, given the times we find ourselves in, as covered by Dave's content, and a lot of companies will have engaged in quite difficult engagement with employees and clients in recent times. So moving on to the next slide, I think the question is, in practice, what might one of these statements look like? And while there is a lot of guidance out there to help with interpreting the new reporting requirements, a lot of judgment will be exercised here and making it relevant to the individual circumstances of that company, of that group. So I have just listed some of the key points which come out of that guidance from the FRC, the Financial Reporting Council, and the type of things that should be covered as part of directors' duties. So the first point there is recommending that we go through that 6-point list and just pick out those key issues, those key stakeholders that will be relevant to include in a section 172. And on what basis we've determined their relevance. Moving on to the main methods that the directors have then used to engage with those stakeholders and understand the issues the company has faced during the year. And then finally onto the impact that has had on key decisions and the key strategies throughout the year. So I have mentioned a couple of times that they're fairly broad headings, and what should be taken here on the disclosure part is that this is very judgmental on whoever is writing this statement. It should be based on individual circumstances and whatever is most meaningful and informative to the shareholders, covering those matters of strategic importance for the readers of the financial statements in a company-specific way, essentially. So moving on, I did mention quite a lot of overlap here with regards to the different stakeholders that we're attempting to cover off. And the second requirement is a separate statement around employee engagement, which again, some of you may have seen before. It's important to note with this requirement that it does apply to those just with employees over 250, not just your large company criteria. So essentially you could be a medium-sized company with over 250 and you would have to do this statement as well. But for those large companies that have already prepared that 172 statement, we would expect at minimum a little bit of cross-referencing here to consider that engagement with employees, the employees' interests, and the impact that has had on the key decisions made. Similar story on point 3 there. This does revert back to being a requirement of large companies now, albeit again you might find yourself with a lot of cross-referencing here because you have included it in the section 172 statement when it comes to fostering those relationships with key suppliers, customers and any other stakeholders that you deem relevant. So requirement 4 is energy and carbon reporting. I did say this looked to be the trickiest of the lot. The one slight reprieve here is the reporting dates change slightly, so we're talking about a requirement for March 2020 year ends. However, I suppose that's very much the territory we are in now, and large companies will have to start to think a lot about tracking these disclosures and thinking about what's required in the current period and those year ends that have just been closed. And I'm not going to pretend I've seen a lot of these disclosures, nor as auditors have we audited a lot of these disclosures, so I may be tempted to give you the requirements here and run away slightly, albeit if there are any follow-up questions, please leave them in the chat and we obviously will follow up and happy to look into those further. But the requirements here you can see are largely aimed at disclosing a company or group's UK energy use and carbon emissions. So you've got the annual emissions there in tonnes of carbon dioxide. You're then required to put a figure on the total energy consumption of the business in kilowatt hours, I'm reliably informed. And then finally, sum up the methodologies used in those calculations. We're required to disclose those methods as well. So as you can see, probably we're going to have a challenging area of disclosure there to contend with, and equally auditing that disclosure. So again, happy to follow up on that one where it does apply to those watching. And the final consideration around a separate corporate governance statement, again I will brush over slightly given the metrics that are involved there, but this just involves the content would be which corporate governance code is being applied, where it's relevant, how it is applied, if the company has deviated or departed from the code and why, that type of thing. But again, if there are anyone in these circumstances where they need a little bit more information on that, we're always happy to help. And to finish up the main content of the webinar, we thought it was best to touch on the key elements of FRS 102 triennial review, as Dave pointed out at the start. And although a lot of people may now have seen these, and this may serve as a little bit of a reminder in some respect, there will be others where this now becomes mandatory for a lot of recent year ends and that may not have seen this up to now. We also didn't quite believe that we'd be providing a very robust accounting standards webinar if we didn't at least get a mention in of the triennial review. So as a reminder to some, and for the benefit of those that don't really know what I'm talking about yet, these amendments to the accounting standard are relevant to the periods commencing 1st of January 2019. So we're talking about our December 19 year ends again, being the first period for mandatory adoption. That being said, early adoption was or is permitted in some cases, and you'll quickly see that a lot of the changes are positive changes. They're relatively good news on the most part, as Dave promised, and it's just intended to amend and clarify the standard where FRS was first introduced, and there were a lot of that nonsense disclosure, as Dave put, that we're trying to clear up. So let's get into the main points anyway, and if there are any questions that pop up on those, we'll be happy to delve into a bit more detail. So given I've just mentioned that it will be all good news stories coming out of this, I thought it only fitting that I start off with the bad news, and that is in relation to investment property valuations, which has been heavily on the radar ever since FRS 102 was introduced. The story here is that previously we had an exemption on the requirement to obtain valuations where it could be argued that this resulted in undue cost or effort to the company, outweighing that benefit that we get from those valuations. And in short, this exemption has been removed, and therefore anything accounted for as investment property would be required to go through that valuation process, whether that be your typical investment properties that sit on the balance sheet, or even those mixed-use properties whereby a proportion may be rented out to a third party. We would be required to do that split now. So in short, yes, we have to do it. This slide, it is worth mentioning, does focus on investment properties. However, this does apply to the other sections of the standard listed there. So whether that be your investments in subsidiaries and associates, investments in joint ventures, your property, plant and equipment, especially where the accounting policy, or particularly where the accounting policy adopts that held at valuation approach as opposed to cost-less depreciation or cost-less impairment. So everyone is now wondering where the good news is coming from, and rightly so. So if we move on to the next slide, it does stick with investment properties. And there was always some contention on how we should be treating the properties which are used within a group situation. So this typically crops up where you have one group company which holds all of the property, whether that be head office or warehousing, manufacturing plants, and rents to another group company. So in this example, we've used the typical parent-subsidiary relationship there. The parent owns the property, the subsidiary is the tenant. And the good news here is that where previously FRS 102 set out that we should be accounting for this as investment property, and that would revert us to the previous slide, we now have that accounting policy choice between investment properties and property, plant and equipment. So you're probably ahead of me on this one, but we very few instances see people opting for investment property, and we can then avoid that valuation exercise which is mentioned in the previous slide. So again, happy to dwell on the details of that one a little bit more, but for now we'll move on to another key area of the triennial review. Basic versus non-basic financial instruments. Sounds complicated by the title. However, in a nutshell, this is just a little bit of tidying up in the standard. I won't dwell on the details too much at this late hour. However, they have clarified the standard in this respect when it comes to which financial instruments meet the definition of basic, and therefore we can account for those on an amortized cost basis. And those which include non-basic features such as your derivatives or interest rate swaps, any hedging instruments where we would have to go down that fair value route. Essentially, they've applied a common sense approach to this stuff in relation to your typical loan instruments, where previously it may not have been obvious that they were basic financial instruments. However, if it has all the typical features of a loan, we should essentially just treat it as such. So I won't go into the wording of the amendment there, but it's all about specified cash flows and a repayment schedule, and whether the lender gets a typical return in the form of fixed or variable interest. All of that kind of stuff points to a loan, so we should just treat it as a loan and treat it as basic. So it just makes it a little bit easier to highlight those financial instruments and classify them as basic. Next slide, and sticking with financial transactions, I'm sure a lot of you are aware, having encountered FRS 102 on transition, that, as Leanne said, there was this discounting exercise required for long-term loans, and most frequently those were seen between group entities, which are effectively classified as a lower than market rate of interest. So we often see the 0% loans between connected entities is often typical. And we end up with this discounting at a market rate of interest, which intends to recognise that the receiving company is receiving a benefit on that 0% loan as a capital contribution. So a very similar situation to that CBILS exercise Leanne went through. However, usually in a lot more extreme conditions where this benefit applies to the duration of the loan agreement. So to cut to the chase, the good news on this one is that an exemption can now be applied in small companies if this loan is provided by the director shareholder or close family member, and we've provided the definition there of the close family members, and it's essentially aimed at those who can be expected to have influence. And the only other thing to note on this one is that we can adopt this one on a cherry picking basis. So we can adopt this one without all of the other requirements that I've gone through and that I will go through. I suppose that becomes a little bit of irrelevance when we're talking about mandatory adoption anyway, but with the rest of the requirements that we've gone through, it is either all or nothing. On to the next key area of the amendments, and that's around intangible assets and acquisition accounting. Again, without dwelling too much on the intricacies, this aims to get rid of something that was proving very difficult in practice when FRS 102 was first introduced. And this is around acquisition accounting and assigning goodwill paid for an entity to the individual assets that you believed you were paying above the net assets figure for. So this could be any intangibles such as brand values or customer lists or contracts, the right to sell a product, anything intangible that you believed you were purchasing above the net assets figure, we could assign to those individual assets essentially. But again, putting a value on those assets or even attempting to put a value on those assets proved very rare in practice, and therefore this is no longer a requirement if you meet the criteria set out there, which is A, being paragraph 18.4, which sets out just the general recognition criteria of an intangible asset. So we're talking about the probable future benefits of an asset and having a reliable measurement of cost, that kind of thing. B is whether it has arisen from contractual obligations, and C is just whether it's separable as an asset in its own right. So we have to meet all three now to have to go through this exercise. We do have that accounting policy choice where we meet A and either one of B or C. But again, you're probably ahead of me, and it's rare that people will voluntarily choose to split out their goodwill figure as opposed to just lumping it into one where it's not clearly obvious that it relates to separable intangible assets. And finally, I did promise at the start, as did Dave, that the majority of this is good news, and therefore this slide just backs that up a little bit more. The first point is around FRS 102 introduced quite the onerous financial instruments note, which resulted in a lot of inconsistency between entities on what should be included. Parts of the standard were open to interpretation. There were a lot of grey areas, and this has just been simplified to only include those assets and liabilities which are measured at fair value. So going back a few slides, we're talking about our non-basic financial instruments that would then require a separate note. So that just makes the disclosure a lot more simple, and you would only do it if you had those fair value assets and liabilities. Moving down, KMP compensation relates to key management personnel, which often just resulted in a little bit of duplication, especially in your smaller owner managed businesses, where it was just the directors that were considered key management personnel. So where this is now the case, we don't need to disclose that separately, and you would only start to think about that if you considered other members outside of the directors, other members of your senior management team to be key management personnel. Third one down, a particularly least favourite, I think, amongst most, was the requirement to disclose the amount of stock recognised as an expense in the period through cost of sales or write-offs. However, this has been scrapped completely, you'll be glad to hear, so we don't need to contend with that one at all going forward. And finally, the one that does go the other way is the reintroduction of a reconciliation of net debt as part of a cash flow statement. It's previously a feature of old UK GAAP. It's been reintroduced, but I think it's certainly considered to be more useful than some of those disclosures that have been scrapped. And I am slightly conscious of the time, so I believe that brings to an end my triennial review reminder and the main content that we have for you this afternoon. I think we're going to move on to 5 or 10 minutes of going through some questions that may have popped into the chat function, which are hopefully aimed at Dave and Leanne, given I went last, but we'll see. So I will pass back to Leanne to see what's cropped up in that chat function.
Yeah, thanks, Martin. Yeah, we've got a couple along similar lines, so I've just tried to summarise them. Unfortunately, the first one is targeted at you. So on the filing extension, we're just being asked what year ends are likely to be impacted, and is the extension being granted automatically, or is there an application process?
Yeah, so we have realised quite recently that Companies House have started applying these extensions automatically. So for those filing deadlines that fall within that window of between the end of June and the 5th of April 2021, they seem to be automatic, and working backwards from that, this would relate to June 2020 year ends being the last period, which would effectively now give you that 12-month filing period instead of the 9 for your typical limited company. So as we say, it does seem to be automatic, and we would just recommend for your own peace of mind, I suppose, that it is always worth performing that company's house check, just to double check what your accounts due date is stating on the company's house website by performing that check, just as a caveat there.
Yeah, okay. We just got one about CBILS, so just saying I'm applying for a CBILS loan now, but have a December year end. Would the calculation for discounting be the same, or would I need to consider prorating this? Well, I think simple answer is yes. You'd need to prorata the figures to represent the portion of income and interest relating to the financial year. But overall, really, as in the example that we looked at earlier, there's going to be nil impact overall on your P&L. Technically, this should be done using the effective interest method, but again, it's unlikely to be material in practice rather than just using the straight line method. But the cash recognition and how to calculate the initial liability part, how to recognise that and calculate that would be exactly the same. So then just in terms of non-adjusting events, and also just to clarify, so we've got a company with a December year end, and some customers have closed since the year end due to COVID. So would they need to consider writing off their debtors' balances at year end?
Shall I pick up that one? I think strictly, if you do have a December year end and a customer, because of COVID, is unable to pay you, then the technically correct answer is that's a non-adjusting post-balance sheet event. So if the customer went down in March and it's specifically COVID that meant they couldn't pay you, then you wouldn't have to book it in your December 19 numbers. I think the one note of caution I'd have there, and slight skepticism, I guess, is were there any pre-existing conditions with that customer? Were they struggling already? Were they really in a position to be able to pay you at December? Or was there some doubt over that receivable at that point in time? Because I think that would put a different slant on it.
And then just one more, so last one, just with regards to going concern. So we're just being asked, is it reasonable to expect that an auditor should take into account the nature of a client? So for example, this is a public sector organisation, and their ability to generate cash either through the normal course of business, known grant funding streams or funding markets when we're forming a going concern review. And then just what sort of evidence would we be looking for as an auditor when forming your view? And also a lovely comment saying that this presentation is really good. So thank you for that.
Thank you.
I'll try and remember all of that. I think the quick answer there is absolutely the approach should be specific to each entity. I would track back a little bit and say that the starting point is probably, if this is a company, let's say for the directors to make their own assessment and their considerations as to the going concern view or basis. And if we think back to when I was chatting about that, if we think of it as a scale from no concern through to material uncertainties, where does the business believe that they lay on that? But yeah, if there's various sources of cash funding, if there's trading, if there's grant funding, if there's the ability to raise money through a debt or other investment of some sort, then that's all relevant. And it's the persuasiveness, it's the likelihood of each of these things coming in. Clearly, something having happened is a lot more persuasive than we think it's going to. So confirmed grant letters in the case of grant funding, known orders in the case of trading or commercial activity, and commitments or even getting over the line in terms of any sort of funding. So it does very much have to be looked at on a case-by-case basis. You shouldn't be applying a one-size-fits-all here. It's understanding how the business runs. It's understanding where the sources of funding come from. I hope that answers that. I hope I picked up the various elements of that question, but do feel free to get back in touch with us if there's anything else that you'd like to discuss on that, whoever asked that question.
Yep, so I mean that's everything that we've got in, so we haven't got any more questions for today. But like Dave just said, if anyone does have anything they want to ask, please feel free just to get in touch and we'll obviously come back to you.
Right, okay, well, it's 2 minutes past 5, so I'm conscious that we did say 5, so we'll start wrapping up. Thank you to Martin and Leanne for that today, and behind the scenes to Maxine, Richard and Daniel for making today happen. I think it's gone without a hitch. And finally, thank you to everyone who's taken the time to join us. I hope it's been useful. As I mentioned at the start, there should be a feedback icon on your screen. Just click on the link that you're redirected to as you go to log off. And please do let us have your thoughts about today and any other topics you'd like to see in the future. As Leanne mentioned, if there's any questions or any other questions, do feel free to get in touch. And a bit of a plug, our next webinar is an M&A and markets update on the 6th of August. There is a link in our chat box if you'd like to register. And there's also a link there, and they're on our website, previous webinars covering grants, VAT, employment taxes, cash planning. Feel free to have a look and do get in touch. Thank you. See you all soon. Bye.
Thank you.
Thank you. Bye.